In this week's update, time for some selective caution. Is big tech starting a rerun of 2022? And what does a Bitcoin bear market do for gold? My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. What a week. We had huge turmoil on the Friday leading into last weekend, and that certainly continued during the week. But what I said 2 weeks ago about the bullishness and the trends hasn't changed one little bit. We've seen some, with the benefit of hindsight, some necessary readjustment of pricing because gold and silver, particular, also to a degree copper, was just getting ridiculously overheated. It had to come back. So this is actually a healthy thing, as unpleasant as it might be in the short term. But look, this video is going to give you plenty of choices and plenty to think about. So let's get stuck into it. I think last week was a big wake-up call for those that were unaware that this was an unsustainable path. And it's just how markets deal with excessive herd behaviour. And that's what we've seen, fueled by a lot of leverage, which then had to unwind with margin calls. So the thing that you need to understand is, first of all, some parts of the market just went ridiculously high. They should never have been up there. The fundamentals just remotely did not justify it. And then the second thing that happened is that unwind happened very dramatically and very sharply because it's the unwinding of excessive leverage and margin calls. So these are not natural markets. The last couple of weeks is not a natural market. But I still think we've got some more volatility ahead of us, but we'll get to that. I think in 5 years' time, when we look back, as you can do if you want to look at the S&P 500 over the last 100 years, events that at the time were huge, like 1987 and 2008, they're just a blip on the market, a blip on the major trend. And I think what we saw last week, and that may go for a few more weeks yet, I think it's just going to be the same thing because the uptrends for certain parts of the market are just so incredibly strong. But I guess now that we can catch our breath over the weekend, were you spooked by it? It would not be unusual for you to be spooked by it. It's not a bad thing, but if you were spooked by it, then recognise that you need to do a bit more work in terms of getting yourself prepared for it because it's going to continue. Not like last week, but the volatility is going to continue. You're going to be faced with what we saw last week many, many times over in the next 5 years. So if you were spooked by it, then you better do something about it. And hopefully this video will give you some ideas. So why am I more bullish now than at any time in the last 4 decades? And that's really what I said a couple of weeks ago. And the reason is that I cannot remember a time in 4 decades when there are so many simultaneous, unstoppable secular trends. And we're talking really big picture trends here, but also ones that aren't going to change. These are things that mightn't only change every 30, 40, 50 years. We're seeing geopolitical boundaries being redrawn, boundaries in the broadest sense of the word. And the consequences of that feeds into spending on defence. It feeds into AI. It feeds into critical metals. Feeds into a number of different areas. Then we've got this other force that started a few years ago in earnest, and that's a reaction to the US government throwing their weight around, and a lot of the rest of the world's sick of it. And they're also observing the unsustainable debt levels in America. So they are looking for alternative safe havens instead of US treasuries. They're looking around for other places. And I just can't see that that's going to be a short or even medium-term trend. It's going to go on for a long period of time. And then there's the whole issue of self-sufficiency and security, whether it be security around wartime threats, whether it's security around critical minerals for your manufacturing and for your defence. There's a whole different array of factors there. But it's hard to see that is going to change. We've been through decades of globalisation, and it now appears as though that's all going into reverse. And I don't think it's going to be a temporary thing. And then, of course, the really big trends, a world driven by AI. It's going to continue. It's not going to stop. It's going to accelerate. And also the energy transition. I think there's too much committed at stake for that to slow down or reverse in any way. So each one of those really big picture factors is going to sustain an incredible tailwind for that part of the market. Now, that doesn't mean that everything goes up. Initially, they will, and you'll end up with some real rubbish going up with everything else, but then that gets sorted out in corrections like what we had last week. So that's a pretty big picture call on what is happening. Now, if we look at the weight of evidence, to me, as you'll see as I go through a lot of charts in this video, the weight of evidence is shifting. And if you don't acknowledge it, if you stick your head in the sand and hope that everything stays as is, then you're doing yourself a great disservice. And I think more than any time that I can ever remember, it's about astute stock picking. It's about picking the best of the best. It's not optional anymore. It's essential. And I'll show you some charts of the haves and the have-nots in America that demonstrate that. There's going to be this huge bifurcation in the market, some parts of the market doing really well, other parts of the market doing horribly. So if we look at the mega trend tailwinds, any great stock or any sector, when you look over history, has periodic large setbacks. And I've pointed to this previously with stocks like Apple or Microsoft that have gone up so many multiples over a couple of decades. In Australia, stocks like PME Group, they all have, even though they've made tens of thousands of % gains for early investors, along the journey over a decade or two, they all have periodic large setbacks of up to 50%. And that's going to continue as well. So this is not going to be a nice, steady journey. But the key message here is it's not a reason to avoid the opportunities. It's an opportunity to embrace the volatility and use it to your advantage. You just need to be organised with a simple plan and become disciplined around executing that plan. You've heard me say that before. And then the other part is it's not only what you win on, but it's also what you avoid, the disasters that you will avoid. So avoid areas that are sensitive to government policy changes. And there are a lot of parts of the economy that are quite sensitive, and the market quite sensitive to those abrupt shifts in government policy, or indeed any other factor that is outside the company's control or outside our control in terms of the stocks we select, how we enter, how we exit, all those things. So the more that you can remove those things, then you're reducing the number of losers that you're likely to have. And this is not a difficult thing to do, but the reality is it does require quite a bit of time to do the research to get this right. The US fundamental picture, the earnings season is going along reasonably well. The earnings coming through so far are constructive and overall they're positive. But we've still got these rotations in force away from big tech. And just this week, particularly with Amazon over the last couple of days, we've now got a very significant acceleration of that rotation. It's been going on for the last 4 or 5 months. But I think it's now moving into a new phase because it's now impacting the Amazons and the Googles and the Metas and all those sort of stocks as well are going to get drawn into it. So my view is that it's essential that you stay with the existing uptrends. You want existing momentum. Don't try and pick bottoms. Don't try and pick the lows in a cataclysmic sell-off like we saw in some stocks last week. Play it safe. You can still get great returns playing it safe. Stay with existing uptrends. When we look at the Aussie fundamental picture, we've got a bigger picture rotation to the smaller end of the market, and that's highly likely to continue. But when we look at the charts, last week was an absolute shocker. But as I said at the start, they will just appear as a blip on the radar when you look back in a few years' time. So use these large dips to advantage, but you need to be focusing on the quality opportunities. When it comes to commodity stocks, what we saw in the last week and a day is a technical reset. Those massive falls were not due to any change in the fundamental tailwinds or with the companies themselves. We just abruptly shifted because of the unwinding of that excessive leverage and enthusiasm. We just saw a shift back to more sustainable technical patterns. That's all it was, but it's overshot. It's overshot massively. But that sets up an opportunity. Now, it might not be next week, so don't be too anxious to jump back into the market just because commodities recovered on Friday night. I think this has still got a little bit of a way to play out. So overall, it's what I call the price of admission. We've got an opportunity to create wealth over the next 5 to 10 years that will be beyond almost everyone's expectations. But this volatility is the price of admission. But you can do very well in this kind of market, but not just by turning up at the door. You've got to do some work, both upfront and on an ongoing basis, to keep yourself safe and to keep yourself on the right side of the ledger. And of course, really important that you get whatever other advice that you need, because this market, as positive and bullish as it is over any time frame beyond 6 months that I've ever seen, the pitfalls are enormous. This can be a dangerous market if you're not on the top of your game. So make sure that you get all the essential advice lined up. All right, let's look at the American stocks. The S&P, with a recovery on Friday night, ended up down 0.1% for the week, but the NASDAQ was down a lot more, and by nearly 2%, and that reflects the impacts on stocks like Amazon and Google and Meta, etc. The Russell reversed last week's down. Last week was pretty ordinary, mainly because of what happened on Thursday and Friday, but it reversed that almost exactly. So last week it was down 2%. This week it's up 2%. So that's a huge outperformance. And also the equal weight S&P, the RSP index, was up 2.1%. So RSP up 2.1, S&P, which has got the impact of all the big cap stocks, was virtually break even. So there's a huge divergence between where the monies are flowing. The good thing that came out of last week is that the breadth is improving. Now, the tech reset is at the really big end, so the end that really affects the indices. That took its toll on the indices. But when you look at the whole market, then the breadth is improving. So you've got to distinguish between what a whole lot of stocks are doing and what the index might be saying. They can be very different things. So I think we're moving to a position where there's less concentration risk with the really big tech stocks, but there's far more selection risk. There's a lot of stocks that have gone up because the tide was lifting all the boats. But earnings season is going to uncover those ones, and we're going to see the continuation of some very, very savage sell-offs in stocks that disappoint the market. The US dollar index was up a little bit, about 0.5%. And the rallies really were around the likely Fed appointment of Kevin Warsh, which would appear to be a done deal now. The 10-year yield didn't move hardly at all, 4.23, and the VIX was at 17.8. So now let's go and look at some charts, because this really does tell the story. So we'll start with the NASDAQ composite. And if we remove this last candle, so this is a weekly chart. So remove this last candle and what we were looking at as we were last Sunday, then this looked as though the next break was going to be to the upside. That's what the market was telling us. But last week changed things quite a bit. And whilst it's on a weekly chart, it's still over a pretty big range. This now opens the door. So this is not my opinion. This is what the market fund flows are telling me. The door is now open for possibly some sort of major top forming and a rollover for a period of time. and perhaps like what we saw in 2022. So I'm not talking 1987 or 2008 here, but I'm talking about a decent sized correction that makes it really important what you own. So it's far too early to say this consolidation sideways could continue on for a month, 6 months. I don't even think about it because it's an unknowable thing. But how it resolves itself is now uncertain. I felt very confident this would resolve to the upside just a week or two ago, but now my mind is open to this perhaps resolving to the downside. We are seeing, if you look at the individual stock level, we are seeing some heavy distribution in many tech stocks. And a lot of that will be driven by institutions that, they don't tend to change their mind every week. These are more medium-term trends. So there is also some very concerted accumulation in many of the tech stocks, and I'll show you some examples of each of these. But look, the weight of evidence has weakened, in my view, and let me show you why. So first of all, this is the NASDAQ versus the S&P, and you can see we had a consolidation period and now quite a dramatic change. Now, it might only be very temporary, it's too early to say, but we've definitely seen a significant sentiment shift in that spread. And it's not dissimilar to what we saw in 2021 and 2022 when the XLK, the US technology sector, went down for 12 months. So the growth rolled over in February of 2021 and it dipped quite deeply and broke these swing lows. So that was the confirmation that this was a major top. But then it managed to rally, as it often does, just to throw us off the scent. And it chopped around for another 3 or 4 months until we got to November of 2021. In fact, that's more like 6 months. So that's 6 months of chop after we got the confirmation. And then it got into the downtrend in earnest. So what I'm talking about may not happen next week or next month or even in 3 months' time. But it's a potential shift that needs to be closely monitored because things did get a bit untidy during 2022. And this is consumer discretionary, just to back that up. Another ratio from a different part of the market, the consumer discretionary versus consumer staples. And I use this to great effect when I observed at the end of 2021 that we were getting a significant shift in the market when we took out these lows, which happened in December of 2021. So we had a decline, we then got a rally, and then we took out this low here. This is setting up in a reasonably similar kind of way. So I don't dismiss the possibility that we could be getting a rerun of 2022. And what this is saying is that money is flowing preferentially to consumer staples. And we see that when we get to the relative comparison charts. SMH, this is a bit of good news. Semiconductors are still holding up very well. And that's important, as regular viewers of this video would know. Whilst the semiconductor index holds together, we're not going to get any disasters. We might get some difficult trading conditions, but we're not going to get disasters. Let's look at the relative comparison chart in the US. And the rise of XLP, the consumer staples, so money is flowing. It's a bit hard to see the colours here, but this was right down the bottom of the totem pole not too long ago, and now it's rocketing up the list. So a lot of money is flowing into XLP, the consumer staples. And it just adds to the whole picture. You can't look at this chart on its own and choose one thing and say, aha, that's what's happening. It's a weight of evidence approach. So this adds to the whole picture. XLP versus XLY. Money is flowing more defensively. We've got a global reset of technology. It's been going on for months. But we're now getting some of the bigger stocks joining in, like Amazon. But it's also hugely bifurcated, as I'll show in a minute. We've got the NASDAQ versus the S&P. So there's another breakdown. And then we've got the RSP versus the S&P. So the equal weight S&P index versus the traditional S&P 500. And it's definitely doing better. It's outperforming. Money is flowing down the tree in the US market. And then, of course, we've got the continued strength in SMH. Now, I'll come back to the Australian one because I want to go and look at some of the US stocks. So this is Palantir. It's a market darling, and it appears to be breaking down. And I'll go through that step by step in a minute. But let me say, this is a great business. There is nothing wrong that's happening with this business. The price isn't falling because they're running into trouble. The price is falling because this is part of the valuation reset. This was priced at a drastically high level. And it's been defying the valuation reset, which for many stocks got started 4 or 5 months ago. This only really got started halfway through January, so barely 3 weeks. But there's some ominous signs here. There's undeniable signs of distribution since last November. And there are many, many stocks that look like this, hundreds that look like this. So let me step you through it. Because for a lot of people, you look at that and you think, oh, it's just going sideways, and we've had a couple of days down. But let's take the whole picture in. When the peak formed up here on the 3rd of November, we got a gap down and we got higher volumes. See how the volumes rose and were sustained at a higher level and continued on down to this support level. Now, if this is going to be temporary, then you want to see a bounce with some strength. This bounce was weak. Candle sizes getting really small. We've got plenty of wicks top and bottom indicating indecisive. But most of all, we've got really, really low volume. This is a weak bounce. I want a weak bounce to a lower high. And now we've got lower lows. We've broken this swing low. So we've got a weak bounce, lower high, and now lower lows. And also the volume is rising on the breakdown. So we've broken down through this important support level. The candles are getting bigger, more definite, and the volume is rising dramatically. Now, there are no guarantees about anything, but the overwhelming odds are that this is now in a bear market. Former market darling, and it's in a bear market, and we've seen what happens when that process starts. Look at, in the Australian market, look at 360, look at Catapult, look at Car Group, Zero. Once these bear trends start, after such a lengthy distribution, then they can go a long, long way. So many, many charts look like that in technology. But equally, there are hundreds, and I've got a dedicated watch list, workbook, dedicated to new 52-week highs, which I look through pretty much every day. And this is, don't worry about what the stock is, but Lumentum Holdings, and it's a stock in technology. There are equally as many stocks in technology that look like this. So therefore, you cannot look at the market, the US market, even if the NASDAQ rolls over, and assume that that is the pattern that's going to affect everything. This is why individual stock picking is going to become so absolutely critical, because the divergence between those two stocks is absolutely enormous. And just to reiterate again, the money flows are now telling us that money is nervous. We've got a very sharp move out of consumer discretionary, which includes Amazon. So the Amazon fall over the last couple of days is not helping the sharpness of this, but nevertheless, we already had a couple lower highs, another lower high there, and now we've broken this important support. So it's just about probabilities. It's about weight of evidence. All right, let's move to Australia. The Aussie dollar did move above 70 cents for a little bit. The RBA's first move up in 2 years certainly contributed to that, finished just a little bit shy of it. But it's interesting that the Aussie dollar moved up so sharply when the US dollar was also a bit higher as well. So it's about the rate differential. Australia's in a raising cash rate cycle, and the Americans probably in a rate cutting cycle. So that means that money will tend to flow preferentially to the Australian dollar. And then we've also got commodity strength up until the shenanigans of last week, of course, but overall we've got commodity strength and a very positive outlook. So very significant difference between the two markets. And what we're getting in the Australian dollar's case is we're getting a pretty hawkish repricing of the Australian dollar. Now, our index fell 1.8% for the week, which was significant, but XJR, which is the resources index or top 200, was down 4.1%, but still leading, still clearly leading, but a lot of damage was done. Small caps down nearly 8%. They got absolutely smashed, and that's just a function of it's what happens when you get a dramatic sentiment shift and the volatility like what we saw in commodities last week. So XSO got smashed. XIJ, which is the information technology sector, down 12%. So many stocks there got absolutely carved up. And then the emerging companies index was down 9.3. So a really, really bad week for the Australian market. And 1.8% doesn't do it justice. It was a lot uglier than that. I expect, just based on probabilities, that this high volatility is going to continue for a bit longer, maybe a week, maybe a couple of weeks. We just need commodities to settle down. But don't expect just because we got a reversal on Friday night that it's all in the rear vision mirror. I doubt that very much. I think we're going to be looking at W kind of pattern bottoms rather than V-shaped. So the long-term mega trends are still providing exceptional upside. So if you look out over the next 2, 3, 4, 5 years, even longer, then those mega trends are going to prevail because they're really big picture secular changes. But it's going to be a difficult journey and you need to be prepared for that. So the question to contemplate is, do you have what it takes to convert that opportunity into increase in your wealth? Worth thinking about. Let's go and look at some more charts. But we'll start, first of all, with the ASX 200. And this is on a weekly chart. So sharpish, but looking nothing like what was the reality on the ground. That's XJR. So that was a fairly sharp reversal. But look, we're still trading above the 8-week moving average. So whilst it felt nasty in the engine room, we've got to keep it in perspective in terms of the trend. If we look at the small caps, XSO, that was really quite sharp. So there was a lot of damage done there. If we look at information technology, so this is a weekly chart, and it is very, very sharply down and performing far worse than the American technology sector. It's healthcare, not a lot of change there, but still clearly in downtrend. There's the banks really just staying fairly stable at the moment. And energy had been on a 3 or 4 week rise, gave back some last week. And finally, emerging companies index. That's on a weekly chart. So we've had 2 pretty poor weeks back to back off that peak. But look, what preceded that was 6 or 7 weeks where the price, it's not parabolic, but it's certainly departing from the really short-term moving averages as well. So it was always going to have to correct. All right, just look at the currencies. So that's the American currency. It's a fairly tepid sort of rebound when you look at it on a weekly chart. We broke down the week before, broke down badly. And then there was the Fed appointment announcement, and that sort of temporarily turned it around. But when you look at it on the weekly, it's not bounced nearly as much as I thought that it might have. So I'm not sure that this is demonstrating that it's got legs yet. And the Australian dollar peaked a little bit over 70, but is definitely in short-term uptrend. Now, turning to precious metals, and there's certainly been plenty of interesting things happen here. So gold was up 1.6% for the week, just shy of 5,000, but it's been all over the shop. And in Australian dollars, still over 7,000. So that is extremely profitable territory, and that is not being remotely priced in to Australian gold producers. Silver ended up down for the week 8.2%, so quite a departure from gold. But the range from top to bottom, that's the big story, is 30% range from top to bottom. So 121 down to 78 or down to 64, I think, at the low point. So it's been really quite an extraordinary week. Short term, this is just where I think common sense would indicate the probabilities lie, and that's we're not going to get an immediate rebound. There's been too much damage done. There's probably still some leveraging that's got to be unwound from the system. There'll be a lot of people who are long who don't want to be long, and so we'll probably get selling into the rallies. So that'll set up a kind of a W kind of bottom pattern. Gold is going to be a long-term beneficiary of this whole de-dollarization process in all its forms, also for hedging purposes. And I'll come back to this, also flows from Bitcoin. I think this is another big story that's maybe only just starting to get talked about. So from my perspective, the underlying trends in the metals, gold and silver, are even stronger because the catalysts for what's driving them long-term are even clearer. So I'm even more comfortable about the big picture for gold and silver. When it comes to gold stocks, GDX listed on the Australian market was down 10%, so an absolute smashing. And it didn't really need to be to that extent because Australian gold stocks, certainly with the producers, were undervalued when we came into the week, and the gold price only went down by a small amount. So the average Australian gold stocks are now even more undervalued, and particularly some of the developers are more undervalued than they were. So this opportunity is very much still there. So let me give you just a little bit of perspective amongst all the mayhem of what the last 8 trading days were, 6 trading days, I should say. The fundamental drivers long-term are pretty close to no-brainers when it comes to gold and silver. And I've been talking about that for weeks now. It doesn't really require anything added to it. Gold doubled last year. That's commodity doubling in 1 year. Silver quadrupled in the last year. I mean, these are incredible trends. And if you step back and just ask yourself, well, what drove that? And if it was so powerful, is it likely to continue? And the answer you have to get is, well, yes, it probably is. It wasn't that powerful just for no reason. So when low quality, high cost miners become stupidly overvalued, then that's when we're near the top. And we are not remotely close to seeing that sort of behaviour. In fact, the low quality, high cost miners got sold off along with everything else. So right now, corrections don't end this quickly. So I'm exceedingly doubtful we're going to see a V-shaped bottom. So just cool your jets. Don't be looking to get into the market in the next week or so, because I think there's still a bit more of this to play out. The best of the best when it comes to either producers or developers, they're undervalued as last week, and that still applies even more so. But look, when you've got volatility like this, you need a plan, you need targets, and you need a process of how you buy in, how you take profit if you want to survive and prosper. It just doesn't happen because you get a few tips and you buy a few stocks in the right sector. All right, let's go and look at some charts. So we'll start with silver. So that was silver. This is a weekly chart over the last couple of weeks. So you can see we got massive volatility that all culminated in the previous Friday. We hit a high of 121 and we hit a low of 77. But that was down into the likely support zone. So I'll put this on a daily chart. You can see this was a pretty obvious support zone between 70 and 80. We traded into that, bounced out of it, but then immediately plunged back into it again on Thursday, which was pretty nasty. And then Friday continued down, but closed up more positively for the week. So I'll just go back to that weekly chart. So this was a 16% decline that was washing out some of the excess of what preceded it. This went absolutely parabolic to a stupid level. And so we've had a 42% decline so far from peak to trough, and may not be over. Hard to say. But certainly you want to be open to the possibility that we could get down to around 55 in silver from a technical perspective. When we look at gold, also went parabolic on a weekly chart, daily chart, doesn't matter. And we also had an excursion, but we ended up closing positively for the week, which is the main thing. That's the gold price in Australian dollars. So that's still extremely positive, extremely profitable. This is gold versus silver, the ratio between the two. So naturally, with the outperformance of gold last week, we've seen a bit of a bounce in that ratio. But at the moment, we're still in that adjustment period where silver is coming back into its normal ratio with gold. Let's go and look at the gold stocks. So that's GDX in the Australian market on a weekly chart. So you can see we did pull back very, very sharply on the index from 170 back to 130. But a bit more work to be done there. And GDXJ, which is listed in the States on a daily chart, we saw significant volatility there, but nothing like in Australia. The moves in Australia just far surpassed what we saw in America. All right, let's turn to Bitcoin because this is interesting. And there's a bit of a data problem here. Clearly, we didn't have a week where Bitcoin went to zero. So you just got to try and ignore that. But I will show a chart that clarifies that. So you can see we're in downtrend. We've broken important support. This was important support here at 77,500. That's broken. The next support got broken. This was another really key level. That got broken on a weekly basis. Now, Bitcoin managed to turn around, but if we look at this on a daily, you can see this was a pretty decisive break. But the charts will get a little bit clearer. So this is Bitcoin versus gold in terms of the ratio. But this is where it gets a little clearer. I've gone to the ETFs now. So this is the Bitcoin Trust ETF versus the Gold Trust ETF, IAU, listed in America. And there's no doubt that money is flowing out of Bitcoin into gold using the largest ETFs in each of those categories for the proxy of that. And also, we know fundamentally that money is flowing out of the Bitcoin ETFs at a substantial rate. So this is very meaningful. And the important thing for this point of view is, where's that money going to go? It's not going to go and sit under the bed. It's going to go somewhere else. And some of it, I don't know what proportion, but some of it will go into gold. So this is going to be another driver, money leaving Bitcoin and going into gold and silver. So I think that's something to monitor as well. And the final thing, this is the ETF listed in Australia. This is CRYP, the crypto ETF. And this really does display, without the corrupted data in there, this really does display the huge breakdown that we saw last week. And I think that's just such good news for gold and silver. So just to summarize, Bitcoin has dropped into a bear market. I have no opinion over how deep and how long. But from a technical perspective, all I can say is that that breakdown is very, very significant and should not be ignored. So it raises the possibility, if institutions spend one-way traffic, money going into Bitcoin, are they now backing out? Is there something that's triggering the institutions to now back out of Bitcoin? So is it really digital gold? I don't know. I just pose the question, food for thought. I think the fundamentals are now being called into question to a degree. There's always been the naysayers out there, but the market action is telling me something a bit differently. So the technicals have very quickly become a bit of a horror show. We've got a negative leverage factor, and this does come back to some more fundamental data with a stock called Strategy, used to be called MicroStrategy, and also a number of others, Coinbase and quite a few others. And they're in danger of getting a negative leverage factor. where the average price that Strategy owns Bitcoin at is above where the current level is. So may they be forced to sell some of their Bitcoin, and they are a massive Bitcoin holder. So could they become a forced seller into a market that's falling? I don't know the answer to that, but I wouldn't close your mind to it. And then, of course, where will a good slice of that go? And money is coming out of the ETFs. We know that. There's been $6 billion worth of outflow from Bitcoin ETFs since November. And we also know that Bitcoin hasn't performed like a safe haven in recent years. That's what it was kind of pumped up to be. Like gold as a safe haven, hasn't worked. Then again, I suppose neither is gold all that well either. Okay, let's turn to other commodities now. Copper slipped down to 589. So we got more volatility. It actually got to a low, I think I saw intraday, somewhere in the 550 area. So we went from 650 to 550 over a period of just a handful of days. Enormous. Last week I said I expected copper would go modestly lower or maybe sideways. Well, that wasn't quite right because it actually went a long way down with the volatility, but kind of net, it's really sideways because copper didn't really move from one weekend to the next. There was just a huge amount of volatility in the middle. I also said that expect a period of consolidation. The rallies are likely to get trapped by the longs looking to exit, the same as I think what will happen in the gold space. If we get any de-escalation in all the flashpoints around the world, the geopolitical ones, then we can probably expect to see a powerful rally. But in the absence of that, I think we're just going to get more consolidation. But I think on a big picture level, this is definitely a buy the big dips market, but I just don't think we're at the bottom yet. Crude oil has been pretty volatile itself. 63.5 is where it finished, and I'll just show you a couple of charts. This is XLE, which is the American Energy Index, and it's made a seriously emphatic breakout. Now, as members or the audience would know of this video, I've been pretty negative on energy and crude oil for years because I don't like things that are unpredictable, and there's just so much geopolitics around crude oil that it makes it unpredictable. So it's a sector that I've preferred just to leave alone because I don't need that degree of uncertainty. But there's no denying that this is an extraordinary breakout. And so I'm certainly got my eyes open and my ears pricked up because there is likely to be some good opportunities there. So we've got a new 12-year high and a new all-time high in XLE. Now, unfortunately, it's not been duplicated in Australia, as we'll see in the charts. And long term, we're still going to have this supply overhang remaining. But let's go and look at some charts because they're really quite interesting. So we'll start with XLE, and this is on a weekly chart. That's quite a handy breakout to a new all-time high, and also accompanied by a very significant increase in volumes. This is the American index. So you can see new all-time highs and hasn't been up at this level for 12 years. So this is a meaningful breakout, and you've got to pay attention to it. No matter what you think of the fundamentals, when the market is telling you this, you need to take notice. Now, when we look at the Australian scene, what I did was I compared the XLE with Woodside Energy, WDS, just to get a bit of a sense of how the trends look. And you can see that quite clearly XLE, in the bigger picture, in the medium picture, and in the small time frame picture, US Energy is doing far better than Woodside Energy. But to be a little clearer, I also added Santos to that chart. So all three of them starting at the same point 12 months ago. The red line is XLE in the US, and it's just outperforming our market by a huge amount. And even more than that, Woodside and Santos pretty much where they were a year ago. And all that's happened in the middle is a whole bunch of really disconcerting volatility. So that was the reason I made last week or the week before my point about them being more trading vehicles than anything else. But what we're seeing in the States, this is a very emphatic move. That's energy. All right, so there's the spot copper chart. So this just shows end of day prices, doesn't show all the volatility that took up to 650 and then back down to 550. Nickel was pretty steady, so it's trying to carve out a base at a higher level than where it was, as we'll see. And uranium came off the boil, got up above 100 at one stage, but it's come back to 85. So there's the nickel chart. So we had a bit of a blow off top, got up close to 19,000, and then it's pulled back to 17,000. It appears to be trying to form a base there. And there's the uranium chart. So we spiked to 103 and then pulled back dramatically to 85. Spot aluminium doing something similar. Lithium carbonate has had a fall after a spectacular rise. So we've come back from above 18,000 back to 13,000 something. And that's the big picture. That's over the last 5 years. So it's a positive move. So you can't ignore it that it's underway. But we're nowhere near the peaks that we saw back in 2022. And there's the crude oil chart. All right, so the final message, wrapping it all up. This is really the key question for reflection. Are you equipped to handle this level of volatility? Were you really spooked by what happened last week? And it would be natural if you were. But the key thing is to recognize it. And then if you want to be an independent operator in the market, then you need to do something about it, because the long term looks absolutely amazing. It's well worth upskilling yourself or moving yourself into an environment where you can participate on a more structured basis. I'm assuming that the periodic high volatility is going to continue. I think to assume anything else is premature. So just consider what you need to be able to participate in these amazing trends, but ones that are going to have periodic volatility like we saw last week. So these are the things that I think all investors need. They either need to be able to do it themselves, or they need to be in an environment where they're getting it from someone else. So you need a continually refreshed perspective on what is happening in the market. Rather than just reacting to the headlines, you really do need to get that sharp perspective. You need a clear and simple plan. Anything more than simple just won't work for you, won't work for anyone. So clear and simple plan that focuses around risk management and managing weightings. Know where the outstanding fishing holes are. So what I mean by that is know how to select the stocks that are going to be really strong beneficiaries of these mega trends, and to avoid the stocks that aren't. So stock selection is critical here. And you need the time and the ability and the interest to read the play, as I do pretty much 7 days a week. That all culminates in this Sunday video. So plenty to ponder. There's more information on the website, and there's my email address. And I will be back with you next Sunday, and I'm sure it'll be just as gripping as this week was. So that's it for now. Cheers.